What's your, observation of the election in terms of how you think it could impact the economy or the market?
The move that happened yesterday, right after the election, is one of the largest moves ever after an election. And that's because I think the animal spirits are coming out. First of all, everybody in front of this was scared to death, just like you had mentioned there. I think everybody was expecting a contested election. They were expecting we wouldn't know for weeks. And usually, again, that's kind of that price and proof thing. When everybody starts talking about that, and when everybody says, I'm not going to do anything until after the election, you kind of start realizing, uh-oh, people are going to be on the wrong side of it. And like I like to say, Mr. Market loves to inflict the greatest amount of pain on the largest number of participants at any given time.
Information presented on this program is believed to be factual and up-to-date, but we do not guarantee its accuracy, and it should not be regarded as complete analysis of the subjects discussed. Discussions and answers to questions do not involve the rendering of personalized investment advice, but are limited to the dissemination of general information. A professional advisor should be consulted before implementing any of the options presented. Encompass More Asset Management LLC is a registered investment advisor with the U.S. Securities and Exchange Commission and only transacts business in states where it is properly registered or is excluded or exempted from registration requirements.
Hey guys, welcome back to another episode of the Ducharme Wealth Management Podcast, where we aim to provide education and insight to our everyday colleagues so that they can have better, more meaningful engagements with the financial professionals that they need to engage with. Today, we've brought on Kim Arthur. He is a founding partner at Main Management, a investment company out in the San Francisco Bay Area. He has an extensive background in both the institutional side at large investment banks prior to starting his own firm in earlier in the 2000s. And he has a very unique perspective on how to win this game of investing for not only institutional investors, but for kind of the everyday investor as well. So that being said, I hope you really enjoy what insights Kim has to share with us today. Let's hop into the episode. I really appreciate you taking time to get on and do this. I know you have a busy day and just busy schedule in general, Kim. You're a man of many hats and in high demand. So one of the where I wanted to start this conversation and preface this conversation, because I think you have an interesting backstory, is what you did early in your career before you founded Main, and some of the maybe lessons and insights you were able to glean from that helped form your thesis and sort of the way that you think and operate in the here and now.
Yeah, no, that's it's interesting because it's almost like doing a full circle, Brandon, because when I started in the financial business, I was with a boutique firm called Montgomery Securities. And they were known as like one of the four horsemen. It was Montgomery in San Francisco, Hambrecht and Quist in San Francisco, Robertson Stevens in San Francisco, and then Alex Brown was the fourth one in Baltimore. And what was cool about that is small firm, you could do client first. You didn't have to spend all your time like worrying about politicking. You really were able to fully engage with the clients, and it was fun. And then we got bought by Bank of America in the late 90s. And that was a very different behemoth, because now, little did I know how those things were set up, but you learn pretty quickly that those big organizations, they're set up in these stovepipes, right? So you got everybody had their little fiefdoms, these vertical stovepipes, and it was a whole new setup. And then you realize, like, you started looking around and you realize that people were spending, I'm making up, 50% of their time, politicking internally, as opposed to all their time on the client. And that was a big eye opener for me, because I don't know about yourself, but it's like the day only has so many hours, and you really, like, if you like clients and you like dealing with them, you don't like to have 4 or 5 hours of your day, chunked away from you.
Yeah, that is not an understatement. I think we really appreciate our opportunity ourselves, being a small, family operation, to, spend client first time, and everything we do really evolves around them. So I can appreciate how frustrating that might have felt. What's the, do you have any stories you could share where you learned something that really gave credence or started to solidify, like a moment of epiphany where you said, hey, I there might be a different way to doing this than the traditional, methodology, whatever that was at the time?
Yeah. So there were a couple things, I think, just kind of finishing. I was just kind of thinking through there. It's the old adage that we still use here: small likes small, big likes big. If you're dealing with smaller entrepreneurial firms, we do very well with that. And that's how, like when I started my career, it was that way. But so there were a lot of epiphanies along the way. I mean, the first being that kind of stovepipe organization, and then you kind of realize that you had to be like a vertical runner, a horizontal runner. So you horizontally like set up your own tube, and you'd run. But a good example, a great epiphany. So we did a lot of investment banking business and IPOs. And you can imagine in the late 90s, in that bull market with Y2K going on, we probably had at periods of time, Brandon, where there were probably 5 IPOs per week, 1 per day. You were doing 1 per day. And I remember I used to sit right next to the syndicate department, capital markets. And you go over there, and the guy that ran that, who ran that, he was a salty, crusty old guy, didn't trust anybody because everybody was always coming in and telling him how good their client was to try to get hot issues. And this is when the stock market was going crazy. So most every deal that came out would gap up 20, 35%. And I remember going in there, and I had a hedge fund, OXIF, and they were paying Bank of America at the time. They were probably about $100 million of revenues that they paid to Bank of America, but it was all in the prime brokerage and in their options derivatives department, nothing in the investment banking. And I go to this guy, Dick Smith, and I'm like, hey, Dick, we got OXIF. They want 10,000 shares of, ABC that we're bringing public. And he's like, who the hell are they? I'm like, well, they do $100 million with Bank of America. He's like, they don't do $100 million with me. Get out of here. And I'm like, oh, Houston, we got a problem. How do I go back to the client and let him know that he's not going to get any allocation on this deal and that he's doing $100 million with him and we don't care about him? I mean, those are the types of things that, you really go, oh, and your eyes bulge out of your head, and you're trying to figure out how you're going to manage that relationship.
That's really interesting. So there's this huge client, and they want to get in on an IPO, right? There's a new issue coming out, and the guy that's working the desk is like, well, I don't know. There's no relationship with me. Might be a great relationship for you, but even though it's our same bank or firm or whatever, like, no, get out of here. I don't care.
Isn't that just, it's just mind blowing. You think about that. You're like, how can it be? And the problem is like anything in those companies, if the incentives are set up, whereas in that case, the capital markets, he only got, he wasn't getting any of the revenue share from the derivatives department or the prime brokerage. So all he cared about was his little fiefdom. That's all he cared about. And then clearly from like the flip side, the prime brokerage was kind of set up the same way. They didn't care about anything else inside of the firm except for how they got paid. And it just makes you realize that good companies have leaders from the top that realize economic incentives. And they're like, all right, I have to work within those economic incentives, or I got to change them. I got to change the structure so that this guy in the capital markets there, that he's going to get hurt if he doesn't make sure that the $100 million revenue guy doesn't get at least a small allocation.
Yeah. Yeah. That's what's the old Charlie Munger quote, right? It's show me the incentives and I'll show you the outcomes.
That is so true. And it's funny how basic and simple that is, but how many companies don't they're kind of blinded and they just say, this will be different. This time it's different. It's not different. It's not different. Capitalism is very interesting, I think, as a result of it. It's pretty simple in its basic course. The other one I always think about, Brandon, is it's the old adage where you got a guy running the company and the sales guy comes up. This guy, Art Zafiropoulos, who ran Ultratech Stepper, which was a big semi-capital equipment company down in Silicon Valley, big machines, $1.5 million a piece. And one day, one of the sales guys, he comes, he says, "Hey, Art, who's the CEO, Art, listen, I figured this out. If we cut the pricing from $1.5 million to $1.2 million, I can sell a lot more of these." And Art looks at the sales guy and says, "I don't need you if I cut the price. It'll sell itself."
Yeah. Well, show me the incentives. I'll show you the outcome.
That's so true.
So I think one of the things that's interesting when we've talked in the past is that when I think about people in investment banking or even, prior to not necessarily even investment banking, but just like the proliferation of the broker dealer space that existed in the 70s, 80s, 90s, right? What people would think is like the classic interaction of I have a stockbroker, or I'm going to call up my guy and I'm going to get some shares of that. It was really before the rise of ETFs and index funds, right? So you even back then you started having mutual funds pop up, right? In the 90s, there was certainly plenty of mutual funds available, but primarily brokerage business. And I would say a lot of stock picking. That's really how investing sort of used to be, was that a lot of stock picking, whether it was you had a broker that was selling you individual issues, right? Or individual names, or a mutual fund, and the managers of that mutual fund were doing the stock picking, right? And that's not at all what you do. So you came out of your experience in that investment banking world and said, for one reason or another, stock picking is not for me.
Yeah.
What led to that, moment of experience? And then what did you land on? What was your takeaway? What'd you move forward to?
Yeah. So the one thing you did learn, on the sell side, and this is very, very important. We were a shop, Montgomery, that had analysts that had individual stocks. And you found out very quickly that you wanted to be selling the stocks that the analysts own personally in their personal account. Because if something was going wrong, if you called them up and if they didn't own it, they had no clue, even though they may have only had a coverage of 15 names. If they didn't own that name, they're like, oh, I didn't realize it's down 35% today. What happened? You're like, what happened? You're the analyst. You're supposed to tell me what's happening. But that is something that, you want to always make sure that there's shared interest, skin in the game. So I think what happened from that individual experience, because I grew up with individual stocks for the first 15 years of my career, which was very, very important to kind of learn what moves an individual stock. It's obviously earnings, it's the growth rate, it's rate of change, it's product cycles, it's all those things together. But in 2000 through 2002, there was a big epiphany that happened at that point. And that was something called Sarbanes-Oxley and Regulation FD. FD was full disclosure. And that was the period when the little guy was actually all of a sudden put on an equal footing with the big institutions. Because the big institutions before that, they could call up, if it was Fidelity, they could call up Intel or Cisco's CFO and say, I own 5% of your stock. You guys are reporting earnings next week. what are you going to earn? And the CFO would be like, uh-oh, I'm not supposed to tell them, but we're going to earn 25 cents. Okay, thank you very much. Where everyone else couldn't do that. Well, they realized that got so out of control with that inside information being spread there that they basically outlawed that. And they said, you will sign this regulation, full disclosure, and you will sign Sarbanes-Oxley. And if you get caught doing that, you will go to jail. That was a game changer. And that was right around the time when, we started this business that we had. And I'm like, oh my gosh, I've got to do some research into asset allocation and what matters. And as you found out there, going through that asset allocation, you found out that it was really the asset classes had a bigger impact than the individual names. The individual names mattered, but if you had an overall asset allocation, I like to say the easy thing to think of is I would rather own the worst stock in the best group than the flip of that, the best stock in the worst group. And that's because the sector or asset class there has a lot more impact on what's going to happen with all of the constituents inside of it. So that was the big kind of sea change move going from growing up in individual stocks. I love it. I wouldn't have changed that for the world because you really had to learn about what makes those individual pieces of the puzzle move. But then in that 2000 through 2002, that was a sea change. That really, really leveled the playing field.
So you came on to the realization, okay, you got to be not in the right name, but in the right, just part of the market. And so how does that affect, so now how do you guys identify now from a broad stroke, how do you tell what's the right part of the market?
Yeah, that's the tricky part. That's a great question. We're still constantly trying to figure that out. But no, with in all seriousness, it's different people have different approaches on how they go after that. Again, going back that I grew up in the single stock world, very fundamentally driven. That's my go-to is on the fundamentals. And so within those fundamentals, what really matters is the price of the sector or asset class that you're looking at, okay? And the valuation of that sector and asset class. And you can kind of put a mosaic together where, let's say you break things into deciles, into 10 buckets, and you look at fundamental valuations, factors like price to book, price to sales, dividend yield, cash flow. You can put all of those together. And usually what you see happen is a sector, and an individual stock could potentially do it too. A sector is going to kind of move along that continuum depending upon how good their earnings are, how good their product cycle is. And you can start to see patterns and trends that happen. And there's a lot of granularity under the cover. If it's a, sexy tech growth that's been in favor for a while, it may live above the halfway mark, and its entire life might be between the fifth decile and the 10th decile. Or maybe if it's more of a cyclical piece that's not as sexy, it may live between 0 and the 5th. But that's how you kind of get around it there. You find you find valuation metrics that you see that have some longevity and duration in them. And then you start kind of building out these spreadsheets that you can look at and see where something's living. And you're like, we got a product cycle coming here. This thing's going to get a boost. It's going to probably have earnings that are going to accelerate here. And that becomes the catalyst for it to hopefully move to a higher level.
Okay. And so would you say that's a reverting to it's a historical averages? So sort of a long-term mean reversion idea almost?
Yeah, there's definitely mean reversion that happens for sure. but it's not the only thing. I think the other part around it is, I like to use that word that sounds like a FDA phase 3 trial, GARP, growth at a reasonable price. And I think even, GARP is even more important, because reversion to the mean almost to some people implies that, if a stock or a sector, it was up here, it had gone from 20 to 40, and then that means that it's going to go back from 40 to 20. Well, if it's a growth one, it may continue to go 20 to 40, 40 to 50, 50 to 60. It can fake you out. So I think you have to kind of look. There is a little bit of reversion across those continuums, like you said, but there's also different catalysts. And the other thing I love to look at, Brandon, is like price and proof rarely happen at the same time. And this kind of goes back to that single stock knowledge, learning about it, where an analyst had a stock at 10, didn't like it. It went to 20. He finally comes in and upgrades it at $20 and tells you that he thinks it can go to, 23. And because he has all the information, the price and proof at $10, he was scared to death. And little did he realize the market had kind of discounted all that. So there is a little bit of the reversion, and there's a lot of the GARP, and there's a lot of looking for a catalyst to get it to start moving.
I cannot imagine how tough it is to find the catalyst in your guys' work. That seems to be the most daunting, right? Building a spreadsheet is one thing, and looking at where it's at currently, but identifying a catalyst that, okay, this could be what, accelerates the trend or the growth or earnings or whatever it might be. That's got to be a whole nother layer.
Well, but you could just, on that for a second, think about, like in healthcare, a catalyst could be regulation, right? Where you have a regulatory environment that changes, and that becomes it goes from a headwind to a tailwind. Or in technology, you get product cycles, whether or not it's a new iPhone product cycle, like, okay, we got a new iPhone. So that means that they're going to have to consume semiconductor chips. They're going to have to consume software that goes on it. So it is difficult, but if you try to take it in bigger chunks and look at bigger themes, it becomes a little more manageable.
Okay. One of the questions that's coming to my mind is that if sectors kind of come back to their long-term averages, or they hit these catalyst points because of product cycles, whatever it might be, and if you're a long enough time, over a long time, that's what happens. And so this idea would be good for somebody that's a long-term investor, right? Like you're not going to try to catch a long-term trend as a short-term investor. Yeah. Where is the advantage in trying to employ an active strategy, like picking sectors at strategic times versus like just buy, say, like S&P 500 index, something that tracks that or something? Like where could the potential advantage or disadvantage be?
Yeah, that is a really, you're nailing on a great question there, because it definitely is time in the market, not timing the market. So the reason why you would try to employ a sector rotation strategy is going to be that there's certain times that some sectors are going to be disadvantaged. They're going to be out of cycle. And so if on the margin, you can try to find a handful of them, if there's 11 sectors, and you can find 4 of them that that are in their sweet spot, you might get a better outcome than just the regular market. And then in addition, that could probably give you a smoother path. You could have some more less volatility that comes out of it. But I'm a big proponent, Brandon, and again, we are an active, I like to say we're an active manager of passive indices, passive beta. But I'm a big believer that you can marry in your pie. You can take some real cheap, low cost, S&P 500 or growth NASDAQ, whatever it is you're going to use. And then you can marry it with someone like us or somebody else that's trying to do a little more on the, a little bit different. And you're going to be able to have like a complementary connection with it. Because I do think in general that, strategies have their positive parts and they have their negative parts. And you want to try to find those managers that you can cycle together and make them very, very complementary. But for someone, if they just say, and I would not be opposed to this, Brandon, if someone just came to you and said, hey, I got a kid here and I'm trying to, the kid was just born and I want to put some money together and have them, try to start saving for their college, which is going to be in 18 years. And then they'll need to take it all down on average in 20 years.
I think we got to be really careful what we say next.
Yeah.
I know where you're going with this. Do you mind if I complete your sentence and tell me if I'm right?
Go ahead.
It might be reasonable to buy or find low cost ideas that get you broad diversification to the U.S. economy.
Right.
Is that fair?
That is very fair. But what I was going to throw on top of it, the reason why the next thing that I say to that person is, you will probably not have the discipline to hold on to that position for 20 years. Somebody at a cocktail party will talk you out of it and put you into something else. And that's why you need to have advisors like yourself, Brandon, because you are able to take the emotion out of it. You are able to keep them on track. You are able to keep them going towards their goals because they're constantly being barraged with trying to be thrown off. So that was the other piece.
I know that is so true because I cannot go golfing without getting paired up. Like somebody else that gets paired up and will always say, so like it comes out, what do you do? I'm in wealth management. Oh, should I be buying Tesla? What's your thoughts on NVIDIA? What's your thoughts on these names? And I always tell them like, I don't know. Look, I don't know you. And I have no idea what your financial situation is or what's currently in your portfolio. So like you're asking me to give you an educated opinion on something I'm not educated on at all. And it's not that I'm uneducated on, these issues. It's that I'm uneducated on your situation.
Exactly.
And, but because people are always asking me the question, it's like, I know people have the shiny object syndrome. They always are looking to change. Right. And there's always a reason to feel like whatever you have is underwhelming. Yep. And there can be so much volatility in single issue names. And there can also be so much risk in the market as a whole that people, it's too easy to get, like exactly like you said, like somebody's going to talk you out of it at a cocktail party. The last couple of years, there's so many times that I've heard people say like, oh, should we, so-and-so said I should be just buying all gold. I should have my whole portfolio in gold. Well, gold's done great this year. But aside from that, like has gold done great the last, 10 years? Exactly. There's periods where it's done really well. But like, should you just abandon your long-term strategy for gold? Probably not. Like, is it prudent to have some in your portfolio? That's definitely up for debate. But like, don't completely deviate from your long-term trend. But it's so easy to get scared out of, hey, the stock market's going to go to zero, which, what the hell does that even mean? And so buy all gold. There's a cognitive disconnect completely in that train of thought, in my opinion. But people just don't know, they don't understand like what they're really even hearing or then repeating or being scared into. And then on the flip side, it's so easy to say, well, in my planning, in my financial planning, if I made 10% a year on average, man, I'm going to hit all my retirement goals. And then you're getting 12 or 14 or 16 and it all seems, like that should be, things should be banging along, right? You should be like celebrating that win. If your planning kind of mandates, and if without taking additional risk, you're getting more return than you were expecting for the level of risk. But all of a sudden you got a buddy saying, well, oh, look at me. I bought, this semiconductor company early in the year and it went up 1,000% or something. And you're going, man, if that would have only happened to my entire portfolio, I could have retired next year or something. It's like, yeah, but that same company that I referenced there is likely about to get delisted and go to literally zero.
Exactly.
Randy,
you just nailed on something there. That was another thing. I always love it because everybody that you meet, they always tell you about, oh yeah, NVIDIA, I bought that when it was $4. And you're like, wow, $4 to 145. I mean, you must be like retired now and every, all the, well, they forget to tell you they bought 0.000001 of a share. It was 0% of their portfolio. And they don't tell you about the 20 other names that they bought at 10 that went to 5.
Yeah.
That doesn't make them look very good. And you know better than anyone, when you look at actual retail experience, and you can see it all from the mutual fund data there, they print that all the time, their returns are less than inflation because of exactly what you're talking about there, that emotional side there. Unfortunately, they're buying high and selling low. And that is why, again, I say people like you are doing God's work. You're out there getting in front, helping these people and saying, I am not going to allow your emotions to blow yourself up. I am here to help you.
Well, I'll allow it because it's their money, but I certainly try to do everything I can to talk them out of it. But anyways, so one of the interesting aspects that I think you have a lot of really good insight on, Kim, is the ETF space, right? Because one of the things that people seem to always talk about is, well, if we employ this active strategy, right? One of the things that we lose is tax efficiency.
Yeah.
We lose this tax efficiency. And that's a hot topic. Like, hey, look, I hate paying taxes as much as the next guy. And like if I'm not getting an outsized return on something, then I also don't want a tax drag. There is a point in certain situations where like you do really want to pay attention to that. Yeah. And that's not always the mandate for everyone, but it certainly can be. But you hear that, right? Is, hey, don't do a sector rotation strategy because of this potential tax drag, which there can be truth in that. However, I think ETFs sort of solve for that. So one of the things I want to talk about is like when you first started running the strategy, what was the environment that you were running that in? How did that evolve, and where did it, come to now? And what are the lessons that you learned along the way to kind of get to your final iteration here? Yeah.
So remember, I'm coming at you from the People's Republic of California. So taxes, woo, we definitely have always been very, very tax aware because of the extra burden that they place on us here. And what's interesting is that kind of growth at a reasonable price that we talked about in our methodology here. It was actually very conducive with separately managed accounts to have that active sector rotation strategy because they were slow moving cycles. Typically, when something had fallen out of favor and we were in there buying it at a good price, you typically took 12 to 24 months for its full valuation to kind of move back up. So that 12-month was the key part for long-term capital gains versus short-term capital gains. So it was kind of part of the DNA when we started the firm. We're like, that's very, very interesting. And then as we looked into, building all these strategies with ETFs, the next part that came along is that the exchange traded fund wrapper, which I love to just say it's version 2.0 of mutual funds. Like mutual funds started back in the 30s. And the first ETF wasn't until 1993. And then they really started to explode in the 2000s. But what they solved for immediately was the shortcoming of a mutual fund that the holder of it, were impacted by the other holders of that mutual fund. And if they, like a year like 2022, when equity markets were down and there was a lot of redemptions coming out of growth funds, there was a bunch of turnover. And if you held that mutual fund, you lost 20% in 2022, and they gave you a tax bill because there were taxable gains because of all those redemptions. They had to sell stocks. in order to pay for the people that were leaving. The exchange traded funds have gotten rid of that. And, there's a simple thing just called a custom redeem. And to think of it, the easiest way to think about it is the IRS, really what they're concerned about is when you buy something at 10 and sell it at 20, that's what you should be taxed on, that move from 10 to 20. It shouldn't be when the manager is doing changes underneath the cover and switching out consumer staples for consumer discretionary, or switching out Apple and buying Nvidia. You shouldn't be burdened with having to have a taxable event if you bought that and you're holding on to it. So that was a big piece too, as we looked into using exchange traded funds to build that. We would have kind of a combo of slower turnover from the style that we were investing, and then have these very tax aware wrappers that we could use, these structures that we could use. And then the third benefit you got out of it is they came out there where they were underpricing mutual funds. I mean, you got to have a couple different features if you're going to take market share, and they had the lower embedded fees and the tax aware part. And, that's why you see now that the industry is 10 trillion with a T. When we got into business here in 2002, it was $100 billion. So it's been pretty explosive. And most of that's just come out of the hides of mutual funds.
Yeah, when I look at mutual funds today, I find that most mutual funds are in people's portfolios for the practice management and ease of use kind of feature for firms, not for the benefit of the client.
And also a lot of retirement accounts, they don't allow, I mean, it's changing now, but they've only allowed mutual funds to be used in them. That's starting to change, but that was the big area.
Yeah. Well, and in that too, I mean, so the tax efficiency, if you're in a retirement account, isn't as big of a, as big of a deal. It's not a problem at all, right? You don't get a tax bill in a retirement account.
Yeah. But the expense of the wrapper does matter in those retirement accounts.
I just helped somebody recently that, they had this account, and a younger client, has been saving for years and years. It's a sizable brokerage account. And they told me, and I was reviewing their tax return, and they said, well, I said, well, where is this capital gain coming from? You said you never sell, and where's this, all this income? And he said, well, and I said, like, are they rebalancing that? Are they trading it? What are they doing? They said, well, we've never had a taxable event in that account. I went, okay, well, we'll see. And when I got their statements, they were holding, a couple different, the firm that they had been with, had several mutual funds, like their portfolio was all mutual funds.
There you go.
And so what was happening was exactly like you were saying. At the worst time possible, they're getting tax bills and having to realize gains at, not their discretion, but just because of the fund. So, it was a higher expense ratio. They were actively managed mutual funds. So they were already, participating in active management. There wasn't something there. And they were having the negative tax consequences in an environment in which their primary goal was to be, their stated belief was, we want to buy and hold, this was their opinion. We'll just hold on. We're young. We can withstand volatility. We get it. We want to be tax efficient. We don't want to have taxable events. Right. And I'm going, well, you're not getting really either of those things per se. But they didn't really realize that because no one had explained to them how a mutual fund really worked as a wrapper. Now, I found that some things have to be in a mutual fund, right? Like there's if you want certain commodity strategies that are going to, like short futures contracts or something like that. Like that has to sort of be in a mutual fund. Maybe like leverage exposure within a within a fund that sometimes has to be, especially if it goes long and short with leverage, mutual fund. Right. And then the other thing that I find is, useful on mutual funds is, and this does play into what I think may be the one benefit of mutual funds is, very actively traded mutual funds. So like with us, we trade a fair amount of the Ridex family funds of leveraged mutual funds.
Yep.
And if the expense ratio can be slightly higher on those. However, because of the way the settlement works, and correct me if I'm wrong here, by any means, you're not paying for payment of order flow. You don't have that slippage on the transaction. And so when you're turning it over enough times, right, because of the active trades, then you don't have the same drag from slippage or payment of order flow. So that's a good use case potentially. But outside of that,
totally agree with that. And there's one, I'll tell you, a use case in the ETF space that makes zero sense, but the ETF world is going after it. The money market accounts. Money market accounts are what, 6.567 trillion. Let's call it just a little under 7 trillion.
Yeah.
So the ETF complex is licking its chops. They've recently launched some money market ETFs, and it's like, that makes zero sense. They're trying to tell, first of all, the spread, it's $100 piece of paper. And so it's like a 2 or 3 basis point, 2 or 3 cent spread that they have versus zero on the money market fund that you have. The cost on it is just as high or just as low, either way you want to look at it from the money market fund. So the only feature they're trying to tell you is, oh, gee, instead of having 1 day settlement, you can have immediate settlement. You're like, really? So I got to pay for the slippage. I've got to pay, the extra, all the other pieces so I can have same day. Oh, by the way, if you call your brokerage firm, they will do early settlement for a small fee. So yeah, that makes no sense. No sense to me.
If people knew and understood what slippage was, I don't think Robinhood would exist though. So
good point. That's a good point. That's a very good point.
If somebody will buy it, somebody will market it to them, That's I suppose that's the old saying. Well, I really love the conversation around the mutual funds and the tax efficiency piece, because I just feel like that is such if you run a firm, to me, this is my perspective. You run a firm that is client focused, right? Like you were talking about at the beginning, like, hey, stop politicking, stop, if you remove the barrier of like, oh, we're at the big firm and they said, we can allocate people to these 15 mutual funds and that's all we can utilize in our practice. Like if you have access to the markets, you don't have to politic around the firm and the side deals they made with this to get this fund here and they're getting a revenue back split on that. Like you're just independent. Yeah. It is an easy spot to potentially pick up some really nice alpha and just it's a client first decision that's really easy. Right. So I wish more advisors would take that into consideration, but I just think we're just seeing that they just don't, right? And they'll learn eventually. They'll learn in the years like 22 when the clients lose money and get the tax bill. That's
not a fun time to get that conversation.
You got to have you have to have a good explanation on that one.
That's right.
So, anyways, hey, something that I didn't think we'd really have time or the ability to touch on today is like the election results. Yeah. So we're filming this on the 7th. I didn't think we'd even have results yet, but we clearly do. It's clear Trump victory. Kamala Harris conceded. Yep. He carried all 7 of the, at least I think Nevada and Arizona are still like only 96% reported or something, but it's being widely accepted that he carried all the swing states. What's your, observation of the election in terms of how you think it could impact the economy or the markets? Like any thoughts around that?
Yeah, definitely. I think a couple things around that. I think, we're already seeing, the move that happened yesterday right after the election is one of the largest moves ever after an election. And that's because I think the animal spirits are coming out. First of all, everybody in front of this was scared to death, just like you had mentioned there. I think everybody was expecting a contested election. They were expecting we wouldn't know for weeks. And usually, again, that's kind of that price and proof thing. When everybody starts talking about that, and when everybody says, I'm not going to do anything until after the election, you kind of start realizing, uh-oh, people are going to be on the wrong side of it. And like I like to say, Mr. Market loves to inflict the greatest amount of pain on the largest number of participants at any given time. So in this case there, what it did, people were underinvested in the market, which is why you got the gap up by 3% yesterday and another percent today. And a lot of people were sitting and waiting, hoping that they get a chance to buy things cheaper. And Mr. Market said, no, no, no. So I do think you've got lower tax rates coming. Just by itself, the corporate tax rate, if he's able to push through the lower corporate tax rate that he talked about, that adds 4% or about $11 to the earnings next year. It goes from like 275 to 286. So that by itself is a lift. And then I think you have lower regulation, which the market is looking at there, where they took the financial stocks and they gapped them up hard, because it probably means more M&A activity. It means more IPO activity. We haven't had any IPOs not any, but if you look at the level of IPOs this year, it's been a drought, and we're at all-time highs in the market. So those things will start to come out. That's also a good kind of indicator of when the market starts getting a little frothy, when they start putting too much supply. There hasn't been any supply coming out. So I think that it's growth. I think that it is lower regulation. I think it's a steeper yield curve that benefits the financial firms there. And then, we're going to have to find out about things like tariffs, what that is going to impact. In my ideal world, I love it that if you were going to do tariffs, you put tariffs only on products that we're manufacturing here so that the consumer has a choice. And then you don't put tariffs on things that we don't produce, because that really hurts the consumer. But I don't have any policy input on the situation. But I do think that the market is definitely the animal spirits, given lower tax rates, lower regulation, that benefits growth, and it benefits probably domestic manufacturers too. And the market seems to be kind of responding in kind to that. I'd throw out one other thing. If you look at the flows year to date for the market, beginning of the year, everybody was all fired up when the 10-year Treasury was at 3.8%. All they could talk about is money into fixed income. They were very uncertain on equities. They thought maybe equities would only be, 4, 5, 6%. But fixed income, they thought they could get high single digits. Then through the third quarter, it continued. It was 8 times more money that went into fixed income than equities. For the full year, it's basically been no money into equities, and it's been $725 billion with a B into fixed income and money market accounts. So that alone tells me that people are probably a little misallocated.
Well, I think that goes back to your earlier comment, right, about Mr. Market fools the most amount of people and inflicts the most amount of pain at any given time that he can. And what I found is sometimes when the big institutions and everyone's talking about something where you just scratch your head and say, like, I don't know, like that just doesn't seem like there's a lot of evidence. And they're saying, well, historically this one chart, or if this thing happens, this could go low and there'd be this, and you just scratch your head and go, it's already at 3.8,
Yeah.
Hey, I don't like it at 3.8. I look at a trading range and just go, I don't know how much lower this can really go. And I've been beating that drum, especially like in the real estate space on mortgage rates. And I'm like, I've been talking, hey, mortgage rates are not going back to 4. And I remember at one point people thought I was crazy because I was sitting there scratching my head. I'm saying, I think if the Fed cuts, mortgage rates are going up. I mean, I'm on the record saying if the Fed cuts, mortgage rates are going up.
You were right.
And people are like, this guy's insane. How does that work? They cut more. If the Fed cuts rates, the mortgage rates are coming down. It's like, no, they're not. there was, and I formed that case a little bit of macro thesis, but primarily on technicals, like just looking at the charts and looking at the correlations and relationships. And, anyway, so sometimes it's contrarian to just, it goes back to, look at the news, contrarian, a little bit of common sense, take a contrarian position and decent outcomes.
That's, and you know, that's a lot like I've never studied behavioral science there, but I do a lot of like amateur behavioral, just like you're talking about there. You kind of see, you know, sometimes when everybody's talking about something, it does make sense and it continue for longer. But on these things that are very specific and have a finite term to them, that's when you can kind of like, it goes back to that price and proof. It's interesting too, Powell today in his presser, he said he wasn't overly worried about the backup in the 10-year here. And I think probably just, you know, this is me kind of digging under there, but if you look at kind of a simple average for the 10-year year to date here, it's about 4.2%. So we're at 4.3. And I think that's why Powell's kind of like, yeah, okay, it's not the end of the world. Now, if that thing had a 5 handle on it, that would have been a different presser. But I think, again, you were spot on right when you told people that, you know, hey, at 380 or 365, 375, he's cutting rates here. That 10 years going higher.
It's like, if you slam it, you know, my logic on that largely, it was like, if they slam it to zero, that's so inflationary, 10-year sells off and yields go up. And if they drop it slow, there's a decent chance they're going to have to stop their cut cycle at 3.5. Well, if you're at 3.5 terminal rate on Fed funds, you can't be at 3.5 on a 10-year. That's not how term premium works.
No, exactly right. That's right. 100. Now, the good news, and you'd probably agree with that, historically, the stock market with 10-year between 4 and 5%, it can do really well.
Yeah,
the stock market does very well. Obviously the big behemoths that are cash flow positive, they're just licking their chops because they can at least get paid something on their cash that they're generating while they're waiting to do something more productive in CapEx. But yeah, 4 to 5 is fine.
Yeah. Okay, I got one last thing I'll call out as a little crazy, and then we'll wrap it up. I recently found out. So, did you hear about like the publicly traded companies that issued long duration debt back during COVID? So, you know, 30, 40-year debt, they issued it at like, 3%, call it, on some of these bonds, the original coupons are like 3%. And now rates are high. So they're making all this yield, right? Because, hey, look, they're just sitting on, they borrow the cash from all the investors and now they're just sitting on it, 4 or 5% in money market or, T-bills, whatever it might be. But there is there is a company headquartered out of Seattle area.
Okay.
That is a place that many people may buy stuff from frequently. And they have a fund that they're using that that if people are building housing in an area so they're building affordable housing basically for their workforce.
For their workforce.
Around that would, you know what I mean? Affordable housing that would benefit their workforce in areas surrounding their operations across the country. They're borrowing this money out at 3%.
Wow.
So everyone else has to go do their development projects at 8%, but because they issued this long-term debt, they're able to go out and say, well, we just borrowed it from everyone else and we're passing it through at this cost, but we're getting this fringe benefit of like employees have affordable housing, which then has now now flip it to, okay, well, if you're an equity investor in that same company, you're now benefiting by, hey, the question now arises, can they get away with paying their employees less than other companies because they've now effectively provided quasi-provided affordable housing for their employees.
Sure. Well, it's interesting. I lived in Japan in the late 80s, right before I started in the financial service space. And being young, just out of college, I don't know what's going on, but I remember being amazed there with and Japan was on top of the world then, right? They were about to peak in 1989, 3 years after I went over there. But they had exactly what you're talking about, but it was part of their planned operations. If you work for Sony campus had all kinds of housing built around it. It was almost like you never left college. And they're like, oh, Brandon, you're coming to work for us. I got your room and board. It's set up right here. Here's your desk that you're working at. Go to it. Easy turnkey, easy peasy. And it was a big thing because they're short on land over there and short on houses over there. So it was a very easy, the corporations would compete on who had the better housing facilities, who had the better perks and benefits. And I remember just like, oh my gosh, I didn't realize companies did that.
But so everything goes in cycles. If you fast forward now, it's been 30 plus years, 35 years since the kind of the peak of that, right? In 89. Yep. And housing in Japan, they can't get rid of it.
Can't get rid of it. I mean, people population.
People literally just die. I mean, it's just abandoned houses everywhere. I mean, real estate has literally gone down in value, I think, every single year since 89.
It's so
fact check me on
exactly
that,
right.
But
and that's what, and think about like places like South Korea is even worse. Their fertility rate is the absolute lowest in the world at 0.7. You need 2.1 or 2.2 to replace your population. And so a lot of those, Japan is just been surpassed by China as the biggest nursing home. So that China's real estate, that problem ain't going away.
Yeah.
Because
I sometimes I think about when people talk about real estate as being the ultimate investment, and I don't think real estate's a bad investment. I do a lot with real estate. I help a lot of people with real estate investments, but I'm also very objective about it. And one of the sayings people will say sometimes that just makes me chuckle a little bit. And when they say like, well, just buy real estate, they're not making any more of that, they're not making any more land. It's like,
exactly.
Well, China doesn't have a shortage of land, but if the demand is literally dying,
they got a shortage of people.
Then the value of an asset is only indicative or relative to what somebody else is willing to pay it. And if the demand isn't there, because again, the supply of what was bringing demand to the market has again like literally died. Then it changes the economics of it. So I don't think we're facing that issue the same way in the U.S., but it's interesting to witness it other places.
Yeah, we're still, that's why I'm doing my part to keep us on the population podium, Brandon. I got 5 kids, and I just keep saying I gotta keep producing little demand objects here.
Well, 5 is I feel confident saying I believe that is above replacement rate, but we appreciate your public service there, Kim. Anyways, this has been fun. I really appreciate your time and insight, and I look forward to having you guys back on. I had Alex on a couple months ago, like when I first started the podcast.
Nice.
Earlier this year, and I did have the opportunity to actually meet with him out in your guys' office this summer. Sharp guy, and I look forward to having either you or him back on, or and anyone from your guys' team. You guys have a lot of sharp talent there. So
that would be great. What would be fun too is we'll get you out here and we can do a podcast from our studio with you. So that would be fun to kind of have Shelby set that up and run that. If you come out to do any due diligence with other things that you have out here, love to have that. And really appreciate the partnership with your firm and all the good stuff that you do for your clients, and really appreciate it.
Yeah. All right. Well, hey, we'll talk soon. Have a good one.
All right, man. Thanks.
Yeah,
Appreciate
bye.
it.